Hey, welcome to Market Investor. I'm Daniel Snyder. Thanks for coming back and watching this video. I want to dive right in. We're here to talk about the stock market, and I think right now, more than ever, you need to know that the bottom is not in. And what do I mean by that? I mean, the stock market is going to continue to fall, even though we've had a rally this last week, just because the coronavirus is still out there, right? We don't have a medical treatment to cure or even as an antiviral, which is what we're really waiting on. We're just waiting on the antiviral to be approved so that we can all go back to work. And until that antiviral is approved or until we have a treatment that is FDA approved and it goes through the system and everything checks out, the market's going to continue to fall. And why is that? It's because consumer spending is stopping, right? No one is going out and buying cars. No one is out on airplanes. No one is going to sports events. They're all canceled, right? Until we get past this moment in time where we have a treatment for coronavirus, the market will continue to fall. We don't know when that's going to be. And what we just experienced over the last few days, we refer to as a bear market rally. And why is that? Well, if you take it back, what is a bear market, right? A bear market is when the bearish people are in control. What does it mean to be bearish? You just expect the market to fall down. And they say it's a bear market because when bears attack you, they go with a down force motion with their paws. In contrary to a bull market where a bull charges at you and goes up, bulls want to see the market go up, bears want to see the market go down. Simple as that. But a bearish market rally is kind of just a way that we have algo traders, quant traders, hedge funds, they all participate where even in a bear market, even when the market should be going down, and because the market can do whatever the market wants to do, they have a series of days, if not weeks, even months sometimes, where you see it hit a bottom, it bounces back up. It's called the dead cat bounce, and then it continues to fall. So I just wanted to put that out there, make you aware of it because it's something that you should know. It's extremely important to see that you're not just caught off guard. So with that out of the way, I want to touch on a few things, right? So every day we're getting new reports. We're getting new reports of numbers. We're getting new reports of estimations of how far our GDP is going to go down. We're getting numbers from China again, which is kind of crazy, right? So China's coming back now and saying, oh, we do have a lot of tests coming in as positive for the coronavirus, but we're not claiming the numbers until the people say they have symptoms. It's kind of sketchy. Now we have a lot of people, a lot of banks and analysts that are predicting that unemployment is going to go through the roof, right? The highest unemployment we'll see if we don't get this under control ASAP. But it's hard, right? Dr. Fauci, he's come out. He's the guy that led the whole AIDS epidemic. He's even saying until we get a drug that is not going to be worse than the actual virus itself, right? And that's what they're holding off on right now is this drug mixture that they're talking about for malaria is actually extremely dangerous. So we're waiting to see, is there a certain amount of dosage that we can use to get people back to work? And we got to figure out that dosage. It's a whole thing. So I want to go into the second thing I wanted to talk to you about. Yesterday, in the last video, I talked to you about index funds. And I figured I'd give you more guidance because index funds is really where you should start. It's the definition of an index fund is you're investing in a portfolio that literally just tracks the index. The S&P 500 is an index. The Dow Jones is an index. The NASDAQ 100 is an index. There's no stocks to sell or buy on those indexes. The index is a gauge of the overall market. So what you want to do is you want to find an index fund. Vanguard has a lot of those, Fidelity. But I don't want you to get confused with, there's mutual funds and there's index funds. And pretty much what you're looking at for getting an index fund is one that tracks the S&P 500. And you want it to have the lowest expense ratio that you can get. You don't want somebody in there rebalancing the portfolio is what they call it. And they do it every year. As a portfolio manager, they go in, they go, this company didn't work out, we should move this. And they move the percentages around. And every time they do that, anytime they buy and they sell, they get a commission check. So it's in their best interest to go in and rebalance the portfolio as much as they need to, but it's not in the interest of the investors. The investors will lose more money over time paying the people to rebalance the portfolio than they would earn if no one touched it, right? And this is the biggest thing. And this is why I'm saying find an index fund that just tracks the S&P 500. The Vanguard one that you can't unfortunately join now, it's closed to new investors. The expense ratio was only 0.14%, 0.14%. And that's extraordinary. But you can mainly find a few now that are like 0.15, 0.16, 17. And those are the ones that you want to be looking at. You want to get something invested in that, sort of like an IRA account where you just kind of put it in there. You don't touch it. Just let it be. And once you do that, then you move into your play money of, okay, I want to use this money for stocks. I want to get these ETFs. I want to play option strategies with this. And then we can get into the really complicated to some people. It comes off as complicated. It's not really complicated. We're going to teach you how to analyze the charts. I'm going to teach you what indicators to use. We've got the MACD. We've got the RSI. I want you to know what those mean. I want you to know how these analysts and these Wall Street traders and everybody else knows when something is when there's about to be a big move up, right? What is a squeeze? Who's in the trend? Is it the buyers or the sellers? Who has control? All of these indicators will help make you a smarter trader. And I truly believe that you can be a day trader even if you don't think you can be, right? It seems big, it seems scary. But video by video, I just want to dive into this slowly and hopefully help you understand that it's really not that scary. It's a lot of just reading the news and staying on top of the world. It's understanding how the macroeconomics of the world works. And just, you got to be able to control your emotions, right? When it boils down to it, you mentally have to be in a good place and you have to have an exit strategy, whether you're winning or if you're losing. If you're winning, you want to take those profits. If you're losing, you want to get out of that trade as fast as possible so that you don't drain your entire account. We don't want to see anybody blow up their account. That's what it's called, blowing up your account. We don't want to see that. The last thing I want to touch on in this video is, and I only bring this up because everybody's been asking me, what about the cruise ships? What about the cruise stocks? Can I buy Royal Caribbean? Can I buy Carnival? Don't touch them. Do not touch the cruise line stocks. I'll say it again. Do not touch the cruise line stocks. They're tempting because people see the big numbers of where they were, $150 a share, and now they're down to like $10, $15, $20 a share. And everybody's like, oh, but they'll bounce back up. Yes, they will. If you want to invest in a cruise line stock, go ahead. But if you're looking to day trade the cruise lines, don't do it. And here's why. The cruise lines aren't incorporated in America. What does that mean? It means cruise line A is over in Lithuania where they get tax breaks from that country, and therefore they're not paying taxes to the US government. And that's what's going on with this whole fiscal payout stimulus bill going on right now. And that's why you're going to see the airlines be taken care of. But cruise ships are not essential infrastructure for America, right? It's a luxury. It's a luxury industry to be able to go on a cruise. So Carnival, Royal Caribbean, Norwegian Cruise Lines, they're not going to want to take America's money from the government because the government is going to go, great, we'll give you $7 billion, $10 billion, but you have to bring your company to America and start paying us the taxes that we are owed. And if they do that, no shareholders don't want to own their stock because then they're not profitable. I mean, they're hiring people from all over the world. It becomes a big issue. And that's why I say right now, I don't see them popping up in the near future. Like I said, a few years down the road, when consumer spending happens again, when people are going back out on vacation, they're going on cruises to the Caribbean, Mexico, wherever, that would be a time to get back in. But I just want to warn you right now, don't touch them. Find something else. I've been telling a lot of people, look into technology stocks. Find out what your computer runs on. Find out where the supplies come for cloud computing, right? Where do the hard drives come from? The microchips that run it, just anything in the infrastructure realm of technology. It's pretty much a safe bet right now. But that's all I've got for you today. I'll see you in the next video. Thanks for checking this one out. And if you haven't already, hit subscribe, hit like, and I'll see you later.